So, here's our roadmap for today. 1. The double entry system. 2. Classifying your accounts. 3. The golden rules. 4. The modern approach. And 5. Recording the journal. Don't worry, we're going to learn this just like a language, step by step, starting with the history and moving all the way to writing our very own financial sentences.
All right, Section 1, the double entry system, 500 years of scientific accounting.
Now, this isn't just some modern corporate invention. To really appreciate this system, we've got to travel back over 5 centuries. The double entry system was actually described in the very first published book on the subject by Luca Pacioli, who was an Italian friar and, get this, a mathematician. Think about that for a second. This system wasn't just cobbled together by chance. It was structured by a math guy. It's proven, it's robust, and it is a truly scientific system.
And this brilliantly illustrates the core premise of Pacioli's system. Every single transaction has a twofold aspect. It's honestly a lot like Newton's third law of motion. For every action, there's an equal and opposite reaction. Say your business buys a new desk for the office. Your new asset, the furniture, is acquired. That's the action. But the reaction, your cash balance, is simultaneously reduced. You literally can't have one without the other.
Because of this dual nature, every single transaction affects at least 2 accounts. One account gets a debit and the other gets a credit. By recording both sides, we basically create this brilliant built-in error-checking mechanism. This is exactly what guarantees the accuracy of the accounting work and lets a business confidently ascertain its true financial position at any given moment.
Moving on to Section 2, classifying your accounts, or as we can think of them, the nouns of accounting.
Before we can really use this language, we have to define our vocabulary, our accounts. The first category is personal accounts. Just like it sounds, these relate to people or entities you do business with, but we break this down into 3 neat subcategories. First, natural personal accounts, so actual human beings, like a customer or a vendor. Then we have artificial or legal personal accounts. In the eyes of the law, businesses and corporations are treated as people too. And finally, representative personal accounts, which indirectly represent a person or group, like an outstanding liability for wages you owe your employees.
Next up, we have real accounts. These deal with the properties and assets that the firm actually owns, but crucially, this does not include debt. Think of the physical, tangible stuff you can touch, like land, buildings, and machinery, or even the cash sitting right there in your bank account. These are the foundational assets that will eventually live on your balance sheet.
Our third category is nominal accounts. These are your action accounts, the ones tracking the day-to-day operations, expenses, losses, gains, and revenues. We're talking monthly rent, employee salaries, things like that. Now here's the absolute key point. Nominal accounts are temporary. At the end of the year, they don't carry over. Instead, their net result, whether that's a profit or a loss, gets transferred directly into the capital account.
Okay, Section 3, the golden rules, the grammar of accounting.
So we have our nouns: personal, real, and nominal. Now we need the rules to connect them, right? These are the holy grail of traditional accounting. Every account type we just learned has a specific rule for when it gets debited and credited. For personal accounts, you debit the receiver and credit the giver. For real accounts, those are your assets, you debit what comes into the business and credit what goes out. And for nominal accounts, you debit all your expenses and losses and you credit all your income and gains. Seriously, memorize this table and you can map out any transaction in the world.
Now, if the words debit and credit are making you nervous, take a deep breath. Let's completely demystify this jargon. If you draw an account out on a piece of paper in a big T shape, debit simply means the left-hand side, and credit just means the right-hand side. That is literally it. When we say an account is debited, we're just jotting a number down on the left side of the ledger. Please don't let the terminology intimidate you. It's just directional.
Which brings us to Section 4, the modern approach, translating the rules. While the golden rules are an amazing foundation, the accounting world has also developed a slightly more intuitive way to look at this. Now, what's really interesting about this slide is how it simplifies everything into mathematical increases and decreases. We group assets and expenses together. If they increase, you debit. If they decrease, you credit. On the flip side, we group liabilities, capital, and revenue together. For these, it's the exact opposite. A decrease is a debit, and an increase is a credit. It's a beautifully symmetrical system based entirely on what's going up and what's going down.
Let's look at a super concrete example. Imagine you're starting your own business, and you put cash into the company as your starting capital. Under the modern approach, your cash, which is an asset, is increasing. So, following our rule, we debit the cash account.
At the exact same time, the company's capital, which represents the liability the business owes back to you, is also increasing. The rule for capital increasing is a credit. So, debit cash, credit capital. Perfect balance.
All right, final piece of the puzzle. Section 5, recording the journal, writing the sentences. We've got our history, our vocabulary, and our grammar. Now it is time to write. The journal is known as the Book of Original Entry, meaning whenever a transaction happens, this is the very first place it gets recorded. Think of the journal as the daily diary of the business. It is kept in strictly chronological order. If you don't record things as they occur, day by day, it becomes practically impossible to keep your financial records organized. Let's move to and see how this builds into a formal journal entry. There are 4 precise steps. Step 1, write down the exact date. Step 2, note the account to be debited and write its amount in the left column. Step 3, note the account to be credited, usually indented a bit on the next line, and write its amount in the right column. And Step 4, add the narration. This is just a brief, clear explanation written right below the entry detailing exactly what just happened.
Doing this properly is absolutely crucial for a business. Because it's chronological, you get this complete, timely flow of information. But honestly, the real heroes here are those little narrations. 6 months from now, you might see a debit to cash and a credit to an asset and think, wait, why did we do that? The narration gives you the precise explanation you need to understand the entry later, saving you endless hours of confusion. So, we've gone from a 500-year-old math concept to practically writing out a company's financial diary. You now know the scientific language of money. So the next time you buy a piece of equipment or even just pay a bill, I want you to think about that dual aspect. Every action has a financial reaction. How will you apply this scientific, dual perspective to your next big financial decision? Keep that in mind, and you'll always understand the true story your money is trying to tell you.